Good morning. It's 8:01 on December 12th. I'm Vince Lanci, and this is the Gold Fix, where we will spend about half of our time discussing gold and the second half of our time discussing something else, like macro drivers on the market, like possible gold stocks. I have a mining report today. I have a report on a miner, GSV, which I'll put up in a post separately, but I want to give you a preview of it today and possibly a little bit more on options. But let's get right to gold. We'll start with the technicals. Okay. Well, first of all, let's see where the market is right now. All right. Uh, you're looking at a monthly spot chart, but on the right hand side, uh, February gold is trading 1250 spot four and change. That's a delay. So I'll give you the live market. The live market is about $5 below that. So it's 1251 basically. So we're up two and a half, $3 from the Globex close, not from the Comex close. Yesterday was actually we'll recap yesterday's action first, actually. Why don't we do that? Yesterday was a reasonably robust day given the way other markets behaved. The yuan was stronger yesterday. The dollar had its own moves back and forth, but the reality was that gold sold off, but did not stay sold off for long. For excuse my grammar. So that's a sign of more strength. I have been worried about a regression back to the yuan, and even with a stronger yuan yesterday, I'm not giving you the red line chart today. The market was uh, actually quite strong. You can see this is an hourly chart, but you can see how yesterday the market uh, was started out strong. That's the 11th down at the bottom there. And on an hourly basis, started out strong and then just trended down the rest of the day during U.S. hours before U.S. hours, and then bottomed during the U.S. and rallied later on, and then sold off a little bit again later. But this was, again, we're still in a range. There's nothing to get excited about. But the fact that we're in this range and holding it for so long uh, normally is bearish if you're a gold cynic. But at least one person whose opinion I trust says he sees technically a spike to 1255, 1265, 1280, and that's not the technician that I normally use. So why don't we go to uh, uh, the technicals right now? Take a look at them. So according to Michael Moore, he would advise getting long on a decent penetration above 1252. That's basis February uh, on an upwardly sloping hourly line starting at 820, and look for a decent short covering to come in. We break above 1256, so he seems to be biased bullish today. Go to the downside, he says buy against 1241.80. So 1252 to 1241.80, 1252.20, 1241.80 are his um, uh, levels, we'll say. But he does seem friendly to the market above 1252 spot 20. If you look on the left, 1247.20 is the 2 o'clock or 1:30 settlement on the Comex. Again, a legacy from the floor. So if you're looking at the February contract, you may see two different types of settlements. One will be a reflection of the settlement that matters if you trade gold for your statement. Your position will be marked to settlement 1247.20. The settlement that I prefer to look at because it's a 23-hour market is the Globex settlement that comes later at 5 p.m., which was a couple dollars higher than that. So from Globex's settlement, we're up $2. From the Comex 130 position settlement, we'll call it the end of the day pricing for your statement, it's up $5. So it looks a lot better than it is. It's not the same thing as discussing fair value when you talk about the S&P versus cash, uh, uh, but it is important. And if anyone who understands EFPs and spreads understands why that's relevant. Okay, So above 1252.20, uh, uh, Michael is favorable to the market, and I would agree uh, from a VBS perspective, which we'll look at in a second, as well as from a technical perspective from other days. Over the last week, before we got to 1250, I said there were probably some stops above 1250 based on information given to me by a bank report discussing their own CTA short positions and where their stops were. Yes, that does happen. The bank shall remain nameless. Um, there weren't really a lot of stops there, not the kind of stops that would move a market higher in a big way. So maybe some CTAs did cover there, but they're not going to move a market on sheer volume. If the market moves on a small short covering, that's because the dealers or people who actually make markets are fading it away and letting them pay the highest price. In any event, after those stops are filled, and there were some stops there, the market didn't get slammed. Now, just speaking intuitively and from experience, uh, a market that stabilizes in an area where stops were and doesn't get slammed afterwards, thinking like a dealer or a bullion dealer or a trader or commercial, that's because either A, he's too short and and doesn't want to sell anymore, which is rarely the case, or B, there are stops above that uh, he'd like to sell into as well. So, assuming that commercials are perpetual bears for this conversation, you should note that uh, in a situation where market stabilizes above stops that went off, assuming that what I'm saying is true, you should expect possibly a blow off spike, possibly a little bit of a rally to generate more stops. Now, my understanding is that there's more stops in the 1280 area. I don't. There must be stops below that. I'm not going to give that a high. Like when I said 1250 before, I was uh, highly convinced based on several different sources of information, uh, 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 deep throat, different sources that are in the market and London bullion market area as well. But 1280 doesn't really seem like a big stop area for me. I think there are going to be stops, and this is entirely my opinion. I think there'll be stops in the 1262 to 1267 area. And that's because that is the 12-month moving average, which I talk about repeatedly on this show. And I talk about it because that is where macro players that have bought low will get out. That is where momentum players who want to get in will get in. And that is where macro players who want to get in will get in. So that area is often contended not on a minute by minute violent basis, but on a day by day basis. And we'll talk about that. So if you look at Michael's numbers today, and I want to focus on the upside today, which you can always say that means we're going lower. But I want to focus on the upside because that's where my VBS numbers come in. On the downside, he has 1241 spot 80 for his first level. So he's actually got like an $11, $10, $11 range with no numbers in between. Now, going back to the chart, why I want to go into that uh, on a 1 hourly basis, all right, is basically this. Now, again, you're looking at spot. Now, I have a VBS signal on the radar that I hate to trade in the first hour. It's not super tight, but if you look at the bottom, all right, if you look at the bottom, 5-day volatility is less than 50% of 20. I'm sorry, hour volatility is less than 50% of 20-hour volatility. Um, that usually happens 2 to 3 to 5 bars, sometimes 7 bars before you actually get a momentum signal. So if there were a gun to my head, which is a phrase that traders use to describe indifference, you have to make a decision or you'll end up getting shot. It's a metaphor for you social justice warriors out there. I'm not suicidal. If gold goes to 1,000, maybe I would be. But the point is, gun to my head, uh, uh, based on this system, I would say that knowing that the 5-day, 20-day uh, 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 signal, for lack of a better word, uh, comes anywhere from 1 to 5 bars ahead, I would bet, even as we're breaking out to the upside a little bit here, that we would regress a little bit more and the bands would pinch a little bit more before getting a breakout. So, uh, all the more reason to not trade the first hour. That said, my numbers in the first hour are um, on Uh, the uh, the Bollinger Bands are 12, believe it or not, 1245, which translates to 1250 spot 80 on February. Why don't we just go to February? It's delayed, but but you'll see it a little bit better. What I'm talking about. Ignore the thick yellow line. That's a 12-month moving average that I don't use here. But if you look on the hourly on February, uh, basically we have to settle an hour above 1250 spot 30 or settle an hour below 1247 spot 75, and those are the numbers that I have that'll give me signals. I do not think we'll get a signal in the first hour, and if we did I would ignore it anyway. I would, however, look for one later in the day if we do not get one in the first hour, as the market will chop around inside that. That's it for the VBS. The going to uh, going to actually just throwing you some more VBS numbers. 1254 and 1247 on the daily. There really is nothing. However, coinciding with the technical numbers, uh, we do get a regression to the mean signal if we settle the day below 1242 uh, in spot, which would be about 1247 and change in February. So look for that. On the weekly, which is a chart that got us bullish last Thursday, as long as we're above 1236 now on a weekly close basis, we're good. Now, that's hard to trade a weekly chart on a daily active trader system. But you can look at it like this. Uh, if you're not sure where to put your stops, if you're long the market, you can say, I have a soft stop at, say, 1242, and I have a hard stop at 1236, giving yourself flexibility. A lot of active traders do that. And that's why some traders, Larry Benedict being one of them, really don't like to give out. It's my impression, really don't like to give out stops because they have multiple stops, and the stops are dependent on other markets and how they behave. So, for example, one stop is based on how the market is moving. Another stop may be based on how much you're willing to risk in a day as a percentage of assets under management. But that's it for gold. If you look at the currency markets in general, you're going to see. Actually, I put this up here because I think this is relevant. Uh, this is spot gold divided by the onshore yuan, meaning the one that the government controls. So it's a 60-minute chart. Uh, I think it's very interesting to look at this compared to gold, although I'm not putting them up side by side. But when you look at the US dollar uh, uh, and its decreasing importance on gold, even though it's priced in dollars, uh, and you look at this chart instead, what you actually get is a more uh, uh, picturesque version of that red line that I show against spot gold. What you're seeing is that spot gold is going up against the yuan in yuan terms, which means it's breaking out of a channel. You can see that the channel that was here on the daily is not unlike the channel that we had when gold was uh, 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 tightly correlated. And this is the breakaway uh, that I said would come back to the yuan. But the point is, it didn't have to come that far back because we're pricing yuan. I'd start looking at this chart, especially with the trade conflict. This chart itself, looking at it on a daily basis, this chart I would say is bearish in yuan terms. So that either means gold goes down or the Chinese yuan goes up. Uh, so make of it what you will. But if you take this chart and then you look at, say, the dollar versus the yuan, you end up with the price of gold naked, which is a complex way of looking at an arbitrage. The difference between the onshore yuan and the offshore yuan is relevant to to the price in gold, but we won't do much of that right now, except to say that I think this is a chart that becomes more important. Again, you can ignore the yellow line for this conversation. That's a monthly line. Uh, but clearly, this chart shows more action and more activity for gold, and I think might be a better tell for how you trade gold in U.S. dollars. So maybe you want to look, if you're a technician, start looking at this chart uh, when making decisions on dollar-denominated gold, uh, kind of like a correlation, silver to gold. This is a good way to look at the yuan peg to gold. The time is 8:16, so we're going to finish up on gold. and we're going to talk about. We're going to go through the day's reports. Uh, all right. So while you're looking at that, that's the Opportunistic Traders overnight report. You can see the key bullets there. Those bullets being US CPI will be at 8:30, so we're going to get off before then. We definitely want to be on for the AM show, but just whipping through Asia, starting in Asia. There's really no sign that the arrest of the way Huawei CFO or other steps the U.S. is taking to crack down on Chinese hackers and intellectual property theft is going to stall the ill-defined U.S.-China trade talks, meaning nothing's going to get in the way of it. They're going to push it off the front page or come up with an idea. In Europe, there have been enough letters from Tory MPs uh, uh, turned in. So after weeks of threats, a confidence vote from the Conservative Party will be held with the Conservative Party will be held later today. Uh, this is important. Looking at the euro, if you're looking at the euro versus the pound, or looking at the pound on its own. So pay attention to that as the confidence vote. Remember, this is very political now, and the politics are affecting the markets. And the ECB has a lot on its plate. In the U.S., uh, uh, obviously, the headline and core rates and CPI are expected to converge at about 2.2% year over year. So that'll represent a slowing of the headline rate from 2.5% and a slight acceleration in the quarter of 2.1%. So if Powell is looking for a reason or cover to renege on his own dogma to raise rates, he has it now. He has it, and low oil prices plus a decreasing CPI give him the legitimate excuse to do it. But he's never going to come out and say it. They're going to incrementally move towards it. Uh, uh, this report is very clean. I like this a lot that we're looking at. World stock markets, indices, grains. I'd love to be able to read through most of this, but then I'd be taking away a lot of the content for the 8:30 show. The numbers at 8:30, you have the expectations. Uh, One thing that I think people should keep in mind when they're looking at, say, also with regard to the Fed, the CME's model sees a 76% chance of a rate hike in December. Uh, uh, that's up slightly from a month ago. So, but uh, the stock market isn't discounting a 76% chance of that. Or if it is, it sells off. If the market rallies, it's discounting, say, a 60% chance. The stock market is more susceptible to optimism than Fed funds futures as a CME. Uh, Again, for oil, API oil inventory estimate showed a large 10.2 million barrel drawdown. If confirmed by the EIA today, it would be the largest since July. The market is looking for the EIA estimate of oil inventories to fall around 3.5 million barrels, which would be a huge difference between the 10.2 million barrel drawdown of the API. Those in the oil industry give a lot less credence to the APIs than they used to because a lot of the data was given by industry professionals that have their own access to grind, and the EIA is seen as more objective. It's all debatable at this point. Anyway, have a great day, and be aware that CPI is going to be out today. Look for Trump to tweet on that because those do move markets. The China negotiation will continue to happen regardless of the headlines. That's my opinion. And be aware of the chaos that continues in Great Britain and Europe. Have a great day. This is Vince out.